Linda, John, thank you for meeting with me again today. As you can see here, I've developed a full financial plan for you. If you don't mind, I'd appreciate it if we can start on page 28 there. I know we're kind of flipping towards the back, but I wanted to begin with your investments, just kind of get those underway. I know how much that's really what brought you over to me and how important they were to you. So I really wanted to start off with those and highlight the pros and cons as I see them and kind of where I would take the portfolio as they currently are. As you know, as far as the investments go, we only have 3 accounts that we can currently work with. Linda, we have your taxable account. And then, of course, John, we have your 2 IRA accounts. One's the traditional IRA and one's the Roth IRA. These 3 together are gonna fulfill your full portfolio as far as the investment outlook goes, at least for the time being. Obviously, with sales of houses coming up, sales of companies, other items, lump sum that could be coming your way, maybe with the deferred pension plan, there are some other options available to us maybe down the road. But right now, I really just want to focus on these 3 accounts and really how they correlate and need to really be compatible with each other. I no longer want you to think of them as your account or John's account, Linda, and John, I don't want you to think of them as Linda's accounts and my accounts. They're now your accounts and they're your accounts together, and that's how I've allocated them to take advantage of their tax efficiencies or lack thereof and ensure that the whole portfolio is as tax efficient as possible. So let's start there. Obviously, we're going to need to discuss the capital gains of selling out of some of the products, Linda, that you have, and we'll dive into those in a little bit. But for the time being, I just want to give you a full kind of portfolio view of what I'm looking to do here and what I would recommend. I strongly believe in index investing, whether it's through mutual funds or exchange traded funds. A lot of great companies out there that we can use. Vanguard comes to mind, BlackRock, with their iShares. There's a big push to indexing, as I'm sure you both know, into industry. And it's really something that I think in the long run really helps the investor. And that's really what we're doing here. These are retirement plans for the next 30 years as we're going off Linda's time horizon. And I want to make sure that we're investing wisely for that time. With all that being said, if we take a look first at Linda's taxable account, as you can see here, what I'm recommending are some very diverse index mutual funds, but they're stock mutual funds. And why that is important is, again, because of that tax efficiency portion. Stock index funds are one of the most tax efficient products you can possibly own. They only pay dividends every quarter, if they pay dividends at all. And along with that, they only pay dividends, they don't do a lot of underlining security trading. So there isn't going to be any long-term or short-term gains from any of the from anything that the fund managers did throughout the year. Could that happen? Of course. Is it likely to happen? More than likely. But to be fair, it's going to be very relatively small, especially compared to an actively managed portfolio. So that's why we want to get this particular account in stock index funds, and we want to do it in a way that ensures it's very proportional and it's very diverse, not just here in the United States, but globally as well. So you can see the different types of index funds I'm recommending here: large cap US, mid and small cap US, as well as some international exposure and emerging markets. That's a big fancy ways of essentially saying we want to get you as globally diversified as possible, get you owning as many companies around the globe as possible, because when one sector goes down, that's really going to lift up the other sectors of the market and really going to ensure that your portfolio is low in volatility. And that's what we're looking to do, because when something goes down, something else goes up. Meanwhile, you kind of stay nice and steady upstream. Will there be dips along the way? There's nothing we can do to avoid them. Losses happen, but it's how we rebound from those losses that's going to benefit you. If we could move over to John's IRA, we'll start with your traditional IRA. This is where we're going to look to include our bonds and our bond funds. I want to kind of shy away from individual bonds because that's where interest rate really comes into factor, whereas a bond fund is able to rebound from those changes in interest rate a lot more fluidly, and we don't have to worry as much about default or credit risk whatsoever when we look at bond funds, because they own thousands and thousands of individual bonds. So if one bond or two bonds default, we still have thousands of other bonds that have not defaulted. The downside, of course, is that we'll never know exactly what type of dividend we're going to get from that. It is going to vary month to month. However, it does pay those dividends monthly, and that's why we want them in your traditional IRA. I don't care if Linda's taxable account, because it's in stock funds, outperforms your traditional IRA. I expect it to, but I want them to be working together in order to make sure your portfolio on whole is moving in the right direction. Lastly, with your Roth IRA account, really the biggest thing there is realizing this is tax-free. So any interest that you earn on that Roth IRA is going to grow tax-free. We can't say that word enough. With that in mind, what we want is to make your most aggressive funds in that Roth IRA. So that's where you see and why you see the international and the US small cap. These are the two most aggressive funds that we can invest in, and that's why we put them in the Roth IRA. They're home run hitters, if you will, if you like baseball analogies. They're going to swing and miss from time to time, but when they hit it, it's going to go a long way. So it's a lot more peaks and valleys, but hopefully we get a bunch more home runs than we get strikeouts. With that all being said, the whole picture of your portfolio, all three accounts working together, it's a very low in volatility portfolio. Doesn't mean there isn't risk. There's always risk, but that risk is minimized because of that diversification, both on a domestic and global scale, as well as the diversification lowering that volatility so that you don't see such wide swings. You may see it in one or two funds, but not in the whole portfolio. Let's next move to